Hello and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks. Two key areas I'd like to talk to you about today. The first one being an update on inflation and the likelihood of a Bank of England base rate change come the meeting on the 20th of March. And the second thing I'd like to look at is, given the inflation situation, what are the steps you can take prior to the tax year end to make the most of the money you have? So let's get straight on and look at the latest inflation position. So you'll see from the first slide, so blue line and a red line, the red line being the Bank of England base rate, the blue line being CPI, so that's Consumer Price Index inflation. It's one of the inflation measures, which has just ticked up on a 12-month rolling basis from 2.5% on a 12-month rolling at the end of December to 3% at the end of January. It doesn't sound a lot. Actually, it's quite a big uplift. The reason this matters is because you'll see the red line, having gone up a lot, has just started to tail. That's the Bank of England base rate, and at the February meeting dropped to 4.5%. So the eyes were on the blue line, which is the CPI inflation line, to go, well, would that carry on going down, which would help the chances of a further base rate cut? Or actually, were we going to start seeing that line creep up again to see that inflationary pressure? And as you can see, we have seen that tick up. So actually, that causes a real dilemma. When the Bank of England committee meet, the Monetary Policy Committee, what might they do? So they might look at a couple of other statistics. And by the way, if you're wondering, well, what caused that uplift? Normally I talk about core inflation. This is just the standard CPI inflation measure. Bad news, I'm afraid, if you like your meat, you like your bread, or you like your cereals, because they were some of the big drivers behind the uplift most recently. And there was also an energy price uplift in from a cap perspective in January. So a few bits that caused that inflationary challenge. I always look at a couple of other graphs when I'm sort of trying to get informed around inflation. The first one being unemployment. So said for a while, unemployment is starting to creep up very slightly. That is actually against the backdrop of the number of vacancies are going down and have been going down for the last 2 years in the UK. So at its peak, I think the UK vacancies are about 1.1 million. Most recently, they're just over 700,000. So you think, well, the pressure is coming off. Likely that at the moment there is a lot of nervousness around the impact of the budget and the national insurance increase for employers coming in April. And you're seeing that natural decline in the number of vacancies. Whilst unemployment is trickling up slightly, it still remains kind of relatively low when you look at a comparative basis over the last number of years. And actually, therefore, the thing to look at is the average weekly earnings I talk about. So are we seeing the pressure coming off of those wage increases? Now, obviously, with vacancies coming down, you might think we're starting to see that unemployment creeping up slightly, but we're not. And I always show you at the moment the same graph, which is the jaws. So I look at, well, what's happening to inflation and what's happening to real pay. So that's kind of, as inflation comes down, what we'd hope is typically that the pay rises are just tempered a bit. That takes the heat out of, how do employers look to sort of pay for those pay rises ultimately? And a lot of that might be passed on through prices. So we're looking to see that cool. You can see from the jaws, most recent month end, we've seen a tick up in both the average pay. So average pay is back to running at the weekly earnings. Like the increase is running at 6% again. As inflation kicks up. So to maintain that real earnings, both of those lines have gone up. So the Bank of England are faced with a whole bunch of metrics right now, which do not really give them an awful lot to work with in terms of considering a further base rate reduction for now. So at the moment, it doesn't look great for what might happen come the 20th of March if you're hoping for a base rate reduction, is my view at the moment. But things can change over the next few weeks. And so faced with the inflationary pressure that we're seeing again, as a taxpayer, what can you do? What can you do prior to the tax year end to make the most of the allowances you get? And if you look particularly at areas like capital gains tax, so according to the OBR, so the Office for Budget Responsibility, so their job is to kind of comment on what they see happening in the UK economy. So in 2024-2025 tax year, the OBR estimates capital gains tax is going to generate £15.7 billion for the Treasury. And it's hugely sizable. And of course, when you add that now to the October budget and what was talked about, the capital tax measured amount announced in that budget, they're overlapping a lot. So people typically being hit by a number of different taxation changes, whether that be CGT, so for capital gains tax, for inheritance tax, or of course that fiscal drag of income tax where personal thresholds are not changing in spite of the inflationary measures that we're seeing. So those measures announced in October are expected to raise an additional 5.2 billion between now and the end of the decade. So again, these are quite big challenges that we're all facing potentially, and many of us are facing in terms of the taxation situation. So I thought what I would do just very, very quickly is to canter through what are the 5 things, and there may well be more, but what are 5 things you can consider doing prior to the tax year end? So let's just have a look at them. Number 1, make the most of your ISA allowance. There's been a bit of speculation recently, will the government remove or reduce cash ISA options that are open? At the moment, each year you get an ISA allowance of £20,000. So for the 2024-2025 tax year is £20,000. But if you don't use it, you lose it. So there we go. There's one to think about. If you haven't maximized your ISA allowance, topped it up, or indeed taken any of it, you've only got until the 5th of April to do so. Number 2 is to boost your pension contributions. So pensions are one of the most tax efficient ways to save for the future. You can put in up to 100% of your earnings, capped at 60,000 for most people in this tax year, and get tax relief on what you contribute if you're a higher or additional rate taxpayer. So you could be entitled to even more if you're a higher or additional rate taxpayer. So there we are, boost your pension contributions. Number 3, use your capital gains tax allowance. I just gave you some of those startling figures over CGT that's going to be paid. If you've made a profit on investments, your capital gains tax exemption is £3,000 for 2024 to 2025. It can help you reduce your tax bill, and it doesn't roll over. Really important point, doesn't roll over. So that's number 3. Number 4, take advantage of inheritance tax gift allowances. So each tax year you can give away up to £3,000 without it counting towards inheritance tax. And if you didn't use last year's allowance, you can carry it forward, meaning you could gift up to £6,000 tax-free. So there we go, number 4. Number 5 is consider charitable donations. So if you're thinking of giving to charity, donating before the tax year ends mean you can claim gift aid, which lets charities reclaim 25p for every £1 you donate. Plus, if you're a higher rate taxpayer, you can claim back tax relief on your donations. So it's a win-win. So there was number 5, considering charitable donations. So there are things you can do. So you may not feel you can control anything to do with inflation, but these are steps that individuals can take to gain some control prior to the tax year end. And actually, more than that, if you're listening to this or watching this and you're a grandparent, there may well be other ways and other things you can do to help reduce your tax liabilities through supporting your grandchildren. As with all of the things I've talked about today, my message would give you is to know more, please talk to your financial advisor who will be able to let you know more about what it means for you and the options that are open to you. But you only have a few weeks left to act for a number of these things I've just talked about. So, don't delay would be my message. So there we are. It's a really quick canter through today. I hope it's been helpful. There's the inflation picture. I'll talk again once we know about the Bank of England base rate change. At the moment, not seeing too much evidence that would create a rationale for a further drop. And a reminder again, tax year end, there's a lot of allowances that are use it or lose it. You've only got until a real deadline until the 5th of April, but don't leave it to the last minute. So there we are. That's it for today. Thanks very much for watching. Look forward to seeing you again next time. Take care and bye for now.